Welcome to TheoTrade. This is Don Kaufman. You are watching the Theo Weekend Update for August 11th, 2018. Let's get started with a quick kind of week in review. We're going to jump forward and we're going to look specifically to some positions I'm going to be putting on this next week and really how I'm trading a market that, well, this past week did absolutely nothing, followed by Friday where we saw some decent amounts of volatility. So let's get started. In this previous week of trade, the SPX had right around a $28 expected move. Now, for those of you that kind of follow along a little bit with TheoTrade on a day-to-day or week-to-week basis, you know we look heavily at expected move. So we stayed inside of that $28 expected move. Again, $28 expected move. How does that compare to any recent expected moves? It's incredibly small range. So the SPX was supposed to move 28 bucks. It actually moved under 28 bucks. But throughout the course of the week, all the market did for the most part is rally up to 28.60 and sit there throughout most of the week. I mean, really, like Wednesday and Thursday in terms of trading, brutal, people. However, on Friday, the point I want to make with this is that on Friday, we moved more than we were supposed to move, okay, for the entire week, and we did it all inside of one day. So this logic of being a net buyer of premium still kind of resonates. Now, I'm going to show you in a minute here in the charts a bit more about expected move for this next week, but just to kind of mention, the expected move, like this next week of trade, has moved from $28 to almost $42. So we've got a nice expansion in terms of volatility. Let's see if some of that volatility is actually going to carry through. One of the other major changes throughout the course of this week is, early on in the trading week, as I said, we didn't do very much. Markets were heavily uncorrelated. That effectively means if you look at the S&P 100, 50 stocks up, 50 stocks down, this constant capital rotation, it's what I term a veritable slop fest of trade. That was earlier in the week. On Friday, though, the correlation is in real contrast to what we've seen in any recent trade. That is, correlation kicked in, and at one point during the trading session, we had 90 products trading to one side of the marketplace. Now, granted, the S&Ps did rally back out of the hole on Friday very, very late in the trading session, as some of you might call it. The bulls found their car keys. Now, with what happened on Friday, okay, what can we expect moving forward? Well, we have to dig a little bit more into what I would kind of call like global macroeconomic. And if you're reading any other media and news, all they're talking about is let's talk Turkey, let's talk Turkey. I'm actually not going to look that much at Turkey. I mean, Turkey, net, you have about a $900 billion economy. All right, listen, it crashed, it burned, it's over. Is there going to be some contagion to some of the European banks? Yeah, but again, in terms of the size, okay, we're not looking at anything crazy. We're not looking at anything massive. And I just think that, again, we had a marketplace, all right, coming into Friday. We had a marketplace that had just been up day in and day out, week in and week out. We're just rallying, grinding to the upside. The marketplace was really anticipating and just looking for anything to be able to sell off on. And that's really kind of kicked into high gear on Friday. But again, the S&P is only closed down 14. I mean, that's not even like scraping the surface and doing any damage for the most part. But meanwhile, when the entire financial world has their, Turkey thing going on, they're missing a bigger picture, and that happens to be China. And most traders, some traders are actually into this big, but China happens to be much more of where I tend to be looking, and the Chinese currency, the yuan, is day in and day out is getting devalued. Now, this has a lot to do, obviously, with the U.S. tariffs on China, and I don't want to get into any political side of some of the tariffs, but in the end, if you look at the value of the yuan over the last couple of weeks and really the devaluation of the yuan, first of all, we just hit the anniversary of the big devaluation of the yuan that happened back in 2015, which, mind you, caused a major crisis in U.S. markets just about a week after that. So one of the last real wild moves that we've seen in terms of U.S. equities was actually back in 2015, caused by a devaluation of the yuan. Anyway, with this, right? They are right now ahead of the game in terms of what I would term the currency war. So people are going to look at the tariffs war and global trade. I'm actually looking at the currency war, and right now they're winning the battle because the U.S. dollar just exploded on a breakout to the upside, which actually relates over to gold. So in a time of crisis, right, doesn't look like people are moving to gold. Take a look at a gold chart. We'll look at it here in just a moment. What are they really doing? Okay, they're just going into the U.S. dollar. So it's a lot to think about. Another thing that we're going to get into here in the charts in just a moment has a lot to do, of course, with our positions, some of the positions that we currently have on. We will look at a couple of other positions that we're going to, again, be structuring and how we should be structured maybe moving forward. With that, let's get to the charts. All right, to the charts, to the trades, let's get started looking specifically at the SPX and again, kind of our expected moves, because this is going to define many of the trades that we're going to be looking at for this next week. So as I was saying, this past week was right around a $28 expected move. I got a lot of emails of people that put on butterflies, and a few of you guys actually pulled off butterflies profitably that were right near the upper end of the expected move. Again, that was a $28 expected move higher or $28 expected move lower. This next week, all right, things are getting a little bit more serious, and I am into it. We've got about a $42 expected move higher or a $42 expected move lower. But what I really like to get into on kind of on a week-to-week basis is kind of give yourself a little bit of orientation of where does that happen to take us. And when I say where does it happen to take us, as I zoom really, really tightly in over here, you can see it kind of takes us right up to about 28.75 in the SPX, all the way down to, and I like this, 27.90. So I want to make no two ways about it. I don't want to split hairs. As you guys know, if you've tuned in week to week, month to month, okay, I happen to be a bit of a long-term bear on markets, but I'm very selective in the types of positions that I'm going to take. So I look at the expected move, and I always like to give myself kind of orientation of where that downside of the expected move is, where the upside of the expected move is, because breaking through this range could be either wonderful for my positions or absolutely horrific. And I want to show you how I defend a little bit of this kind of using the expected move. So we know that the upside in the SPX of the expected move is 28.75. And one of the ways I kind of defend myself in the markets is I'm using on a week-to-week basis. I'm actually structuring back ratio spreads. And those back ratio spreads, well, are kind of a savior if we explode to the upside. Now, remember, I have longer duration bearish positions on. In fact, I'm going to show you those bearish positions here in just a moment. But when I start talking about really, trade specific, the kind of trade that I would look at in this particular circumstance looks exactly like, well, what I've brought up down below over here. I've already constructed one. This is just a back ratio spread, and I constructed it to save us a little bit of time. People, it's just a 1 week back ratio. And for those of you that have tuned in, recently, I did the exact or similar trade, I should say, as I did the previous week, right? You're seeing the same structure again here in a back ratio. Last week, we did one for a 19-cent credit, right? And we kept every penny of that 19-cent credit. That is ours. So we kept the 19-cent credit. In this particular week, I'm selling one. Again, that's selling one, okay, of those 284s to buy two of the 285.50s. Now, the ratio doesn't look as good. Last week, I did a 1, okay, by 3. This week, I can only do a 1 by 2. Why? Because the volatility picked up a little bit. But this one's done for about a 13-cent credit. Now, why do this? Okay, because it actually provides me a nice hedge. And I'm going to have to trade some size behind this, and I'll probably actually unload this in terms of the SPX. The Spiders is a wonderful product. It's a soft product. It's a gentle product. The SPX is the mother of all products, and personally, I like trading some of the SPX. I could do less contract size in there, because for me to use a hedge, okay, the size I trade, I got to amplify a little bit. I'm going to have to do a lot of contracts, but I like to explain this stuff using one lots and the Spiders because, it keeps everybody kind of warm and fuzzy. What this trade really amounts to is here's where the market's currently trading. If we explode to the upside, and look at how specific this is, that's the break-even point, but this is worst case scenario, right? But the break-even point happens to correlate right to the edge of the expected move that we saw in the SPX. So here's the bottom line. If we, just rally up a little bit, you're like, oh, I could be taking some pain. And I even showed that you could even lay a butterfly in here and offset some of the pain. But if we rally up a little bit to the upside and then take a little bit of pain with my portfolio too. But if we explode to the upside, okay, that's where this back ratio is going to kick in. Now, let's say the opposite is true. Let's say we tank. Well, partay, because if we tank, first of all, I get to keep the 13 cents. And secondly, Don has bearish positions on right now. And let's get to those bearish positions. So I wanted to start, though, with this back ratio because, well, I've been doing it the last couple of weeks, and it's been working very, very nicely for me. Again, if you compare this to the SPX, this past week, I had that back ratio on and we sold off a little bit and yada, yada, yada. I got to keep the 19 cents. And again, it did its job. I was hedged and needed to be hedged. All right. It's extremely important to me that if I'm carrying bearish positions, people say, well, what do you do if we explode to the upside? Well, that's why I got that back ratio on. Let's get to some of the positions and really get to some of the specifics. In fact, I'm going to start with Caterpillar. I've carried a bearish position on Caterpillar all the way since January 10th. I keep rolling deep in the money puts just to kind of display. I got a great opportunity to roll this out yesterday. I've actually now rolled out to the 150 puts. Yes, I own. I'm not short. I am long the 150 puts. It is a synthetic bearish position inside of Caterpillar. People ask me all the time, would I enter into Caterpillar right now? No. Okay, there's other positions I would enter into right now, but Caterpillar, listen, this thing is, it's getting it done, and Caterpillar right now is threatening for the big break to the downside. So one other aspect in Caterpillar, I would not be selling premium against my in-the-money puts right now. I will not sell premium against him. Why? Because let's, again, not split hairs here. I think this thing is on its way, and that is purely an opinion, but a short position in Caterpillar has played out quite well. Boeing, oh, you laugh, you cry. This thing has been torturing me. But Boeing, I had a really, really difficult time with, okay, recently. And I just needed one down day. And I got it on Friday, and I was able to roll this thing back out. This was an 85 delta when I rolled it to it. So I actually was able to roll my Boeing position, and I even rolled it for a credit. So, yeah, it's not often I got a smile on my face about a position, but this was an absolutely terrible position. And I'm like, I just need a down day. Well, I actually got 3 down days in a row, but oh yeah, Friday, it helped. It let me roll the position. What's my long duration position inside of Boeing? I like it when it's at 200. You like that? So that's Boeing. Continuing on with another position over here. So we looked at Caterpillar. We looked at Boeing. As I cruise down the list, some of the usual suspects, some of you guys are following me in the Morgan Stanley trade. In Morgan Stanley, okay, this is also one that on Friday, believe me, people, I needed a down day, and we got it on Friday. I rolled this one all the way out to October. It's when we actually shot out in an email to all of our TheoTrade clients. But I rolled out in Morgan Stanley, and this is why, when people are like, "How can you be carrying bearish positions? We're at an all-time high." Did you see an all-time high in Morgan Stanley? No. Looks like it's about to break down. Did you see an all-time high in terms of Caterpillar? No, this one looks like it could actually be really cracking. All right. Boeing, hey, I told you, Boeing, I'm taking pain in. I am definitely taking some pain in. Okay. Another one I've got a bearish position in, XHB. XHB, it's been so good to me that I'm all the way rolled out to December. Okay. For a credit. All right. That one can't go against me now. I mean, even if it rallied back up, I am in the money all the way on that one. I've also got another one on Intel. And on Intel, it's working, people. Here's another one that I actually rolled out in time. So I'm now rolled out to the September, okay? And I'm going to look for another roll. Intel needs to back off a little bit, probably into the mid kind of, or lower 47 range, even mid kind of 46 range, and I'll be able to get a roll out of that one. But, when we start to quantify what positions are working and what positions are not, I've got bearish positions on and they're working. If you want to see one that's not working and one that you could possibly enter, and I really do like this position, I do have a position, okay, in terms of the XRT. And this one in the XRT, let me go to the chart here first. In the XRT, it's absolutely torturing me in this position as well. This one's worse than Boeing, but in the XRT, that's a position I've been in for quite some time. You can see I've actually got a multitude of positions. I've got 41 days for this thing to start to sell off, right? And I'm in a little bit of trouble because the XRT has been rallying. But here's one I feel very strongly about, okay? Inside of retail, it was the retail apocalypse not too long ago, and all of a sudden this thing rallies, okay? Now the XRT is very brand specific. Nevertheless, I still want a bearish position in here. Again, bearish to me right now is not stepping up and starting to short, S&P futures. Bearish to me, okay, is being very, very selective at this point in time. Now, as I mentioned on the kind of the video portion of this, I was going to talk briefly about gold, and just briefly about gold, okay? Look at the chart, enough said. So you had a little bit of crisis in Turkey, okay? The lira crashes. And by the way, if you never looked at the Turkey chart, it really is worthwhile because you want to see what a crash looks like? There it is, people. It bounced a little bit, but take a look at like the year-to-date percentage, right? That is hideous. And I don't wish this upon any economy anywhere in the world because in the end, a lot of people are going to have to deal with a marketplace that just dropped literally, 15, 20% overnight, and their currency is going to be devalued. The next thing they're probably going to do, my guess is they're going to probably raise interest rates by about 1,000 basis points, which is, you got to jack your interest rates to, 13, 15% just to try to actually curb the selling of the lira out there. It is it's not a situation that you want to be caught in. And the moment that Turkey absolutely got decimated and the lira went down, what did people do? They ran into the dollar. Now, the dollar is quite entertaining at this point. Now, I'm not a big currency trader. All right, I will trade currencies from time to time. I don't trade the FX market. I actually trade the currency futures, predominantly the ones that are listed on the Chicago Mercantile Exchange. It does appear to me, though, that the dollar has broken to the upside, and we are launching for it. And that's where I started to actually mention the Yuan, Chinese currency, versus the dollar. And to me, forget all the politics, as I said. And if you want to gauge who's really kind of winning, if you will, the global trade war or tariffs, it's kind of hard to say that the U.S. is ahead of the game when the dollar is strengthening, because that is not a positive position for the U.S. And again, the one thing I will always point out, and I like to point out in this time, is if you take a look at a crisis situation, and you really look at a crisis situation, we can go all the way back to, of course, to 2008. The point that I will make with this is, you're looking back into 2008, what did people do? They actually ran into the U.S. dollar. There was a point in time where they actually sold it, but generally speaking, all right, the market ran into the U.S. dollar. And I'll remind you that, there's a lot of gold bugs and so forth. This is just a 10-year weekly. There's a lot of gold bugs out there, people that are just really into the gold trade. But the point that I will make with this is during the financial crisis, gold got hammered. It got hammered because people were running into the U.S. dollar. And my whole logic for that one has nothing necessarily to do with gold and everything to do with the dollar. When all else fails, okay, and when the system really starts to look ugly, okay, our crappy dollar is better than somebody else's crappy dollar, and that's my logic, and I'm sticking to it. And apparently that has resonated and held true even in today's marketplace. So we've looked a little bit gold. We've talked a little bit about expected move. Let's get to correlation. This kicked in big time. We haven't seen correlation this high in quite some time. What I look for, okay, when I talk about correlation, it's just a huge change in the marketplace. All right, we actually had early in the trading session on Friday a 90-10 advanced decline line in the S&P 100. What that effectively means is none of the stocks individually matter. We're not rotating sectors anymore, and we're just going to trade the S&P futures. And it's important to know when we're correlated, because that's when things can start to happen. That's when volatility is going to pick up. That's when the bonds are going to start to rally. Okay, why do the bonds rally? Because they're feeling it. It's serious at that point when the bonds start to rally and volatility starts to kick in, and that correlation, that is that kind of, that third kind of pole in the tent that you want to look for in terms of seeing if markets are correlated. It's about to get serious. One last thing I want to leave you with has a lot to do with the financial. So as I mentioned, I happen to have a longer duration bearish position in Morgan Stanley. Okay, but I also happen to have a multitude of positions inside of the financial sector itself, including an in-out spread that's right on the dance floor of being profitable. Okay, the question for the S&Ps this next week is some sell-side activity going to continue. Again, put the crisis aside in Turkey. All right, again, it's a $900 billion economy over there. I'm not too worried about that. But hey, are sellers going to wake up? Well, if they are, they're going to hit the financials and hit them hard, because the financials have been the linchpin in this market. A lot to think about on this weekend's update. Join us all throughout the course of this week live on TheoTrade. Have a wonderful weekend, everybody. Bye-bye.